Hello class, today we are doing Chapter 8, Personal Finance, Section 8.2, Income Tax. Our objectives today are to determine the gross income, adjustable gross income, and taxable income. We want to calculate the federal income tax, calculate the FICA taxes, or FICA taxes, and solve problems involving working students and taxes. Now, we will first define income tax. Income tax is a percentage of your income collected by the government to fund its services and programs. So, we need to determine our taxable income. And in order to do that, we need to calculate our federal income tax. And that begins with gross income, or the total income for the year. This includes income from wages, tips, interest, or dividends from investments, unemployment compensation, profits from a business, rental income, and even game show winnings. It does not matter whether these winnings are in cash or in the form of items such as cars or vacations. Now, the next step in calculating your federal income tax is to determine your adjusted gross income. Adjusted gross income is figured by taking gross income and subtracting certain allowable amounts called adjustments. These untaxed portions of gross income include contributions to certain retirement accounts and tax-deferred saving plans, interest paid on student loans, and some self-employment cost. In a traditional tax-deferred retirement plan, you get to deduct the full amount of your contribution from your gross income. You pay taxes on the money later when you withdraw it at retirement. Now, let's look at adjusted income. Adjusted gross income equals your gross income minus your adjustments. A standard deduction is a lump sum amount that you can subtract from your adjusted gross income. The IRS sets this amount. Most young people take the standard deduction because their financial situations are relatively simple and they are not eligible for numerous deductions associated with owning a home or making a charitable contribution. Now, you also have itemized deductions, or deductions that you list separately if you have incurred a large number of deductible expenses. Itemized deductions include interest on home mortgages, state income taxes, property taxes, charitable contributions, and medical expenses exceeding 7.5% of adjusted gross income. Taxpayers should choose the greater of a standard deduction or an itemized deduction, so that your taxable income equals your adjusted gross income minus your deductions. Now, Angelo earned wages of $63,500, received $1,850 in interest from a savings account, received $15,000 in winning on a television game show, and contributed $7,800 to a tax-deferred savings plan. He is entitled to a standard deduction of $12,550. The interest on his home mortgage was $6,500. He paid $2,100 in property taxes and $1,855 in state taxes, and he contributed $3,000 to charity. We want to determine Angelo's gross income, we want to determine his adjusted gross income, and we want to determine his taxable income. So let's look at A. Now, we know the problem here, but gross income refers to the total income, which includes wages, interest from savings accounts, and game show winnings. So here, his gross income is going to be his $63,500 from his wages, his $1,850 from the interest in his savings account, plus the $15,000 in winnings on the TV game show. So his overall gross income here is $80,350, which we got by adding all three of those together. Now, let's look at his adjusted gross income. That adjusted gross income is gross income minus adjustments. The adjustment in this case is the contribution of $7,800 into a tax-deferred savings plan. So if we look at $80,350 minus $7,800, we have the adjusted gross income of $72,550 from that subtraction. Now, we want to determine Angelo's taxable income. He is entitled to a standard deduction of $12,550. However, a deduction greater than $12,550 is obtained by itemizing deductions. Okay. Now, let's look at these itemized deductions. You have the $6,500 from his home mortgage, the $2,100 in property taxes, the $1,855 in state taxes, and the $3,000 that he contributed to charity, giving you a total of $13,455 for his itemized deductions. So, his taxable income is his adjusted gross income, which we found to be $72,550 in the previous problem. We see that. Let me see if I can get my pen out. We see that right here, minus the greater of either his itemized deduction or the standard deduction. In this case, the itemized deduction was more, so we will subtract it. Always take the bigger one here. And that leaves us with a taxable income of $59,095. All right. The table shows tax rates, standard deductions, and exemptions for the four filing status categories. Okay, so on the left you have your tax rate, 10%, 12%, on up to 37%. You have on the next column single, then married filing separately, married filing jointly, and head of household. Okay, now your standard deduction is listed at the bottom. So you see your standard deduction listed at the bottom for all of these categories. For single or married filing separately is $12,550. For married filing jointly is $25,100. For head of household is $18,800. Okay. So here's what we have. You have all of these different categories, which tells you the percent here of your filing, your tax rate here. So that tax rate can go all the way up to from 10% all the way up to 37%. But it falls within the different amounts you make each year. Okay. So with the tax table we have here, we notice that if you're married filing separately and you make $200,000, you're taxed at a rate of 32%. Now these percentages can change year to year with the government, but this is what this one's listed at in this particular table for this particular year of 2021. And you can go through depending on your state of single, married filing jointly, and head of household, and find your different tax rate for your different amounts made per year along with your standard deductions. Alright, so in example 2, we're going to look at computing federal income tax. We want to calculate federal income tax owed by a person filing as a return as a single who has gross income adjustments, deductions, and credits are given. We want to use the marginal tax rates from the table. So filing as single, gross income of $67,000, adjustments of $9,000 paid to a tax deferred IRA interest returning account. Alright, so deductions, $7,500 for your mortgage interest, $3,200 in property taxes, $5,450 charitable contributions, $1,500 medical expenses not covered by the insurance, and a $500 tax credit. Okay, so step 1. Okay, and if you need to scan back and forth on your PowerPoint slide to look at the different numbers, you can by all means do that. Take your time to go back, look at the table, look at the numbers, write all the numbers down, and work it piece by piece. But we're going to start out finding the adjusted gross income. Your adjusted gross income is your gross income minus your adjustments. So we start out with that $67,000 of gross income. We subtract that $9,000 for adjustments, we get $58,000. Okay. Now, after we do that adjustment and we find our adjusted gross income, we are going to find our taxable income. Okay. So we're going to take that adjusted gross income of $58,000. We're going to subtract our deductions. Okay. Now, it did list and itemize some deductions for us. What we notice on those deductions here that were listed, we had $7,500 for mortgage interest, $3,200 for property taxes, $5,450 for charitable contributions, and it as well did list $1,500 for medical expenses not covered by the insurance. But what we notice here is it doesn't appear that those are actually covered. Now, what we wind up doing is totaling this up, and if you do total it up, here's what you see. So you see that the $1,500 is not something that you can actually itemize and deduct here. So when we total $7,500 plus $3,200 plus $5,450, we get a total deduction of $16,150. Okay, so just because you list it doesn't mean it's necessarily a deduction. It has to fall within one of those previously mentioned categories within the definition. Alright, so now we're looking at our taxable income equals our adjusted gross income minus our deductions. So we take that $58,000, we subtract the actual itemized deductions that do qualify. So we subtract that $16,150 and we get $41,850 of taxable income. Okay, now we have our taxable income. We want to actually determine what we owe now. We got to determine the income tax. We're going to take the income tax, and that's going to equal our tax computation minus our tax credits. Okay, so this equals our tax computation minus our tax credits. Here we have a tax credit of $500. We perform the tax computation using the single rates from our table. Our taxpayer is in the 22% tax bracket because the taxable income of $41,850 is in the $40,526 to $86,375 income range. Let's stop right there, okay? Because I'm sure this is a lot to take in at this moment, and you're like, where did that even come from? Okay, this is what we calculate. The $41,850 is what we calculated at the end of the last slide. It's right there. Okay, that's where that came from. Okay, we have to calculate his tax bracket based on that number. Now that tax bracket comes from back here. Okay, this is our tax bracket, and remember the one that we're calculating here, he is, let's say he is, where are we at? He's in the 22% tax bracket because it falls within that range. Okay, let's see where we get it. Okay, we're looking and using the singles rate from our table. Okay, so let's see if we can do that. Okay, it does say right here in the question, it will tell you whether or not to file as single, file as married, etc. So we're looking at the single rate, and this is where he falls, or they fall. Right there. So they should be taxed at a rate of 22%. Okay. That is where we get the 22% tax bracket from. So you do have to refer back to the table. It's important. Okay. Alright, so this means that the taxpayer owes 10% on the first $9,550 of taxable income, 12% on taxable income between $9,951 and $40,525 inclusive, and 22% on taxable income above $40,525. Alright, so this is how taxes work. This is where people get a little confused. Just because you make in a different tax bracket doesn't mean that all your money is taxed at that rate. Just the money you make over that next amount is taxed at that rate. So we might have to click back and forth a few times on this one, but I'm going to try to explain it as best I can. So it says 10% on the first $9,550 of taxable income. Okay, so our person scored right here at this 22%, but the first $9,950 is only taxed at 10%. What remains between this number and this number is then taxed at 12%. And then whatever he makes over that $40,526 is taxed at 22%. So he's not truly taxed at 22% overall. Just that last $1,000 or so is taxed at 22%. The amount between the $9,951 and the $40,525 is calculated at that 12%, and that first $9,950 is calculated at 10%. So it's almost like a little step function there. So you're not really truly taxed at 22%, just that percentage overage is. Okay. All right, so let's see how that works out. So if you notice here, our tax is that 10% right here, multiplied by that 9,550. All right, that was that first bit, right, on that 10%. Then that next bit is going to be what was between that 40,525 and that 9,950, and that was taxed at 12%. Okay, so the way we figure out what's between there is we subtract those two numbers. Okay, and that percentage right there is taxed at that 12%. Then our person made $41,850. Okay, now he's only taxed on the rate above that $40,525 at that 22%. So we take what he made and subtract it from that $40,525, and we do that percentage times the 22% there. So here we're doing 10% times the first 9,550, 12% times the additional 30,575 plus 22% for that 1,325. So you can see he's not truly taxed at 20% all across the board. He started at 10, 12 for some, 22 for the last bit. We add all these together to get his total tax though. So he's taxed at $955 plus $3,669 plus $291.50 for a total tax of $4,915.50. Okay. So his income tax is his taxable or his tax computation minus his tax credits. Here he had a tax credit of $500. So we take his $4,915.50, subtract the $500 in tax credits, and he is given a income tax of $4,415.50. Now let's see if we can backtrack. Let's see if we can backtrack here. Yep. Because I'm sure I've got somebody, because I didn't mention earlier where the tax credit come from. That come directly from the actual problem there. So his tax credit here was $500. That is something that was given within the problem. Okay. If they have a tax credit, it'll be something that's given within the problem in this class. All right, so let's look additionally at Social Security and Medicare, or your FICA, F-I-C-A. In addition to taxable income tax, we are required to pay the federal government FICA, Federal Insurance Contributions Act, taxes that are used for Social Security and Medicare benefits. The Social Security provides payments to eligible retirees, people with health problems, eligible dependents of deceased persons, and disabled citizens. Medicare provides health care coverage mostly to Americans aged 65 and older. So let's look at this chart. This chart gives employees' rates, matching rates paid by the employer, and self-employed rates. So for an employee's rates, we're looking at 7.65% on the first $142,800 of income and 1.45% of income in excess of $142,800. So you get 7.65% up to $142,800, and anything over that additionally gets taxed at a 1.45%. Now, the employee or employer is going to match that 7.65% on that first $142,800 paid in wages, as well as matching the 1.45% of wages paid in excess of $142,800. Now, for self-employed rates, you're looking at 15.3% on the first $142,800 of net profits, plus a 2.9% of net profits in excess of $142,800. Essentially, pretty much having to pay the whole thing by yourself there. Okay. If you are not self-employed, so you're not self-employed, and you earn $180,000, what are your FICA taxes? Now, so what we're going to do for the solution here, so this is a straight up question. If you're not self-employed, you earn $180,000, what are your FICA taxes? Well, the tax rates are 7.65% on the first $142,800 of your income. So if you look at where we work it out here, we're going to do the 7.65%, multiply that times the $142,800, right? But you still have to pay that additional 1.45% on income excessive of 142,800. So we made 180 grand. That did exceed that 142,800. So what we're going to do is take 180 grand, subtract the 142,800, and we're going to have to tax that at the 1.45% as well. Okay, so we're looking here after the simplification of 0.076 or 0.0765 times 142,800 plus 0.0145 times 37,200. So that overage here that we calculated from this was just $37,200. That additional $37,200 is taxed at that 1.45% additional rate there. We take and calculate both of those out. We're looking at $10,924.20 initially, plus the additional $539.40, giving us a total FICA contribution of $11,463.60 if we make $180,000 in a year. Alright, example 4, taxes for a working student. Okay, so this should be relatable. If you would like to have extra spending money, so you decide to work a part-time job at a local gym. The job pays $15 per hour and you work 20 hours per week. Your employer withholds 10% of your gross pay for federal taxes, 7.65% for FICA taxes, and 3% for state taxes. What is your weekly gross pay? Okay, so it also asks how much is withheld per week for federal taxes, how much is withheld per week for FICA taxes, how much is withheld per week for state taxes, what is your weekly net pay, what percentage of your gross pay is withheld for taxes, round to the nearest 1/10 of a percent. All right, let's work these one at a time, starting with what is your weekly gross pay. This should be an easy one here. You work 20 hours a week, you get paid $15 an hour. 20 times 15 is $300. That should be your gross pay. That is not the pay that you wind up receiving. That is just your gross pay that you should make, because that is the agreed upon hourly wage times the number of hours you're working per week. Now it also asks for part B, how much is withheld per week for federal taxes. Well, it says your employer withholds 10% of your gross pay for federal taxes. So 10% of $300 is $30. Pretty straightforward there as well. How much is withheld per week for FICA taxes? Well, they have to withhold 7.65% for FICA taxes. So we're looking at 7.65 of, oops, got a little bit of a typo here, guys. It's supposed to be 7.65 of 300. Hopefully you caught that before I did, because we get paid $300, right? So 0.0765 times 300 gives us $22.95 that we are withholding for our FICA taxes. Okay. Like I said, hopefully you caught the typo just as soon as I did, or maybe even before I did. So for FICA taxes, all we're doing is multiplying that 7.65% times that $300 we're making. They're withholding $22.95. D, how much is withheld per week for state taxes? Well, 3% is for state taxes. We're just doing 3% of 300, so 0.03 times 300 is $9. We're withholding $9 a week for state taxes. E asks, what is your weekly net pay? So net pay would be what we get paid gross pay, right? And then we're going to subtract all these taxes that we just calculated. Okay, so it's going to be $300 minus the $30 minus the $22.95 and the $9. Okay, so we're essentially subtracting all of the taxes we have to pay from our gross pay to get our net pay. So we have $300 minus $61.95, which gives us a net pay of $238.05. What percentage of your gross pay is withheld for taxes? Okay, so if you notice in that last problem here, when we did this calculation, this portion here, which come directly from this, were our taxes, right? So $61.95 is the amount of taxes that we are paying. Okay, our gross pay here was $300, so we have our taxes divided by our gross pay that is going to give us the percentage of our gross pay that is withheld for taxes. Okay, in this case, it's about 20.7% rounded to the nearest tenth. Okay, because it asks us to round to the nearest tenth of a percent. You got to make sure you round appropriately here. So, 20.7% of our check is taxes. Not cool, man. Not cool, right? But they're going to withhold them. So you might as well know where they're going to make sure they're calculated correctly. It's well worth knowing about your taxes, how to calculate them to make sure your pay is correct. Because if you don't, you can get taken advantage of. It's well worth learning. This is real life stuff here. But this completes chapter 8.2. Go on, do your associated assignment. And if you have any questions, feel free to email me. I'll see if I can help you out. I look forward to talking with you again for chapter 8.3. So stay tuned, and I'll see you during the next lecture.